In this advanced session, we are going to continue the remaining topics from the previous video. This video is actually part 2 of the concept, so if you haven't watched part 1 yet, make sure to check it out on our channel, the link is in the description. In the last video, we discussed a lot of points. We will pick up right from where we stopped, but before moving forward, if you find something valuable, please give it a like, and if you are new here, subscribe to our channel and turn on notifications so you never miss our latest upload. We'll meet you right after the intro and disclaimer. Let's discuss the double bottom. Subsequently, we notice that the price moved upward, removing the buy-side liquidity that had accumulated above the internal high. At this point, a demand zone is established at the extreme, along with a considerable liquidity pool created by the stop losses of retail traders. In this setup, there is a strong likelihood that price will retrace, clearing the liquidity below the equal highs, then reaching the demand zone before reversing and continuing its main direction. Hence, our present plan is to patiently wait for the price to sweep the liquidity under the equal lows and react at the demand zone. This gives the confluence required before executing a position. As a result, we can initiate a long entry from this demand zone, since the market has already taken the stop losses of retail traders and no further collection is necessary. Therefore, once the liquidity sweep is complete, we can confidently take the trade. As highlighted earlier, the key aim of smart money is to remove all retail stop losses, which is why we should position ourselves only after those stops have been cleared. The same rules that apply to the double bottom pattern also apply to the triple bottom. The only distinction is that in a triple bottom, the price creates 3 equal lows rather than just 2. When retail traders spot a triple bottom setup, they typically enter the market by opening long positions. At the same time, they place their stop loss orders slightly below the equal lows, forming a significant liquidity pool waiting to be cleared. Since the dominant trend of the market is bullish, it must trigger a large cluster of stop losses in order to sustain its upward momentum. Therefore, once the liquidity pool generated by multiple stop losses and pending orders is cleared by price, it provides an ideal chance to consider entering a long trade from the demand zone positioned beneath that liquidity pool. This is because, at that stage, there are no further stop losses remaining to be targeted. Now, let's move on to equal highs. As discussed earlier, equal highs can be divided into 2 types: double tops and triple tops. Looking at this double top formation on the left side, it is evident that the bears gained control after breaking the recent structure downward. The price then retraced upward and formed equal highs close to the unmitigated supply zone linked with the boss wave. The presence of these equal highs created a large liquidity pool above them, composed of the stop losses of retail traders who had entered short positions after identifying the double top pattern. In this case, it is very likely that price will push higher, clear the liquidity above the double tops, trigger sellers' stop losses, react at the supply zone, and then reverse to continue the bearish trend. The same principle applies to the triple top setup, where numerous stop losses and pending orders are positioned above the triple tops, raising the probability that price will return to sweep the liquidity above the equal highs. Therefore, we can look to open a short trade from the higher supply zone, as the market has already absorbed the retail stop losses and no additional collection is necessary. As stated earlier, the main goal of smart money is to eliminate retail stop losses, which is why we must enter after those stops are cleared to ensure a higher probability trade. It is also crucial to understand that if price fails to sweep the liquidity before reaching a point of interest, there is a strong chance the market will use that zone as liquidity to fuel its momentum. Now, let's proceed to the second practical liquidity pattern that we should consistently identify in the market: trendline liquidity. Starting with the bullish case, observe the structure shown on the left side. Here, the price created a bullish boss to the upside, leaving behind a notable inefficiency. After forming a new major high, it retraced downward and then began producing a sequence of small breaks of structure, marked by extremely minor and choppy movements upward without any meaningful liquidity sweep. The key point in this setup is the repeated creation of these smaller breaks of structure. In such conditions, the price gradually trends upward while generating higher highs and higher lows that remain very close to one another. This sequence results in a trend line formed by these minor highs and lows. Retail traders, who depend on trend lines and chart formations, enter trades each time the price interacts with the trend line, positioning their stop losses just beneath it. This behavior leads to the buildup of a significant liquidity pool placed right below the trend line, waiting for the market to target. Consequently, many stop losses are tightly clustered along the trend line by retail traders. In this scenario, it is highly probable that the price will move downward to clear the liquidity under the trend line, triggering the retail stop losses. The goal is to fill the inefficiency left behind and then react at the demand zone located at the extreme. This offers an opportunity to consider initiating a long trade from that demand zone beneath the liquidity pool. Since the market has already activated retail stop losses, there is no further need for additional collection. The core principle of the smart money concept is to take positions only after retail liquidity has been cleared. Therefore, we should enter a trade only once a liquidity sweep on the retail side has been confirmed. Let's move on to the bearish trendline scenario. The same principle applies to the bearish trendline. In this case, the price has formed a bearish break of structure, with an unmitigated supply zone created by the B wave. The price moved downward with inefficiency and then began forming a series of small breaks of structure repeatedly to the downside. At the same time, the price established a trendline using these minor structures. This trendline encouraged many retail traders to enter the market by taking short positions and placing their stop losses above it. As a result, a substantial liquidity pool is positioned just below the upper supply zone. Our approach is to wait for the price to clear the liquidity above the trendline, trigger the stop losses, and then tap into the supply zone. This offers a strong confluence factor we look for before opening a trade. Therefore, we can initiate a short position from the supply zone after retail liquidity has been cleared and inefficiency has been filled. At that point, there is a greater probability that the price will reverse from the upper supply zone and continue moving in its dominant direction, which in this case is bearish. That's it, traders. Thank you for watching this video. I hope you found this video helpful and insightful. Don't forget to subscribe and turn on notifications to stay updated with our latest content. We truly value your thoughts and suggestions, so share your comments below and let us know the topics you'd like us to cover in upcoming videos. Your support means a lot, and we look forward to seeing you in the next episode.